It's J-Rod here for Rich Retirement TV, and today I want to talk to you about one of my favorite topics in the stock market, small cap stocks. You've probably noticed really over the last couple of years, most of the attention that's been paid to the stock market has really been to the top 5 stocks, the biggest stocks in the market. Your Apple, your Microsoft, your Google, Amazon, these handful of stocks that are either at $1 trillion or pushing $1 trillion, and they've really, for their part, they've driven a lot of the market action. A lot of the gains that we've seen coming out of the recovery have been led by those big stocks. But the most explosive gains from during any period of the market really come from the market's smallest stocks. And we call small cap stocks, these are stocks that have market capitalizations of less than $2 billion. And you'll find that many of these stocks actually trade, say, less than $10 a share, which is, for me, that's why I like them so much. They're more volatile than your Microsoft and Apple type stocks, but if you're, say, behind in your retirement, or you're someone like me that likes to trade more aggressively, these smaller stocks can have a much bigger move in a shorter period of time. And right now, we're actually seeing a rotation out of these bigger names into smaller stocks, because as the market has chased these mega cap stocks, these smaller stocks have become very, very cheap, especially those small cap tech stocks. I talk a lot about tech stocks here because they're really the source of a lot of the growth in the market. Well, when you look even closer at these smaller stocks, they're just the gains that we're seeing just over the last couple of months here have been explosive. But really, today I want to show you 2 of my favorite small cap tech stocks right now, and why I think these small cap stocks have a lot of room for growth here as we move forward. So let's go ahead and dig right in. All right. So first and foremost, why I love small caps right now is that coming out of recessions, and we're, the jury's still out on how long the COVID recession is going to last, but coming out of recessions, small cap stocks lead, or they outperform large cap stocks by a significant margin here. I've got a chart here, or a little table here from Invesco that shows in the last 4 recessions, small caps have outperformed large caps on over a 1 and 3 year basis. You take a look here. The margin is wide. So we've got the 2008 crisis, we've got the dot-com bust, the recession in '90, and the recession at the top of the '80s. And as you can see, in each of these periods, small caps outperform. But take a look at this. Take a look at this difference here. We're talking about 7 points. That's significant over a 1 year period, and then over a 3 year period, again, you've got nearly 3 points of outperformance. Explosive growth, and the biggest gains really come in the beginning parts of the recovery out of recession. So you've got historical precedents here for small caps outperforming out of recessions here. So let's go ahead and just take a look. Here's a chart here of IWM. That's the ETF that tracks small cap stocks, namely the Russell 2000 index. And you take a look here. Over the last 3 months, small caps have actually led the S&P 500. So you're seeing over the last 3 months, 30%. We've seen in the gain for the IWM versus a barely 20% or nearly 20% gain for the S&P. So again, almost 10 points of outperformance over the last 3 months, and that's because you've got these big mega cap stocks that are becoming increasingly expensive, and they're leaving in their wake a massive, very, very cheap stocks that are just getting cheaper as money flows. But we're starting to see that rotation out as we're coming towards the end of this the end of the pandemic here, which has caused a lot of the recession here. So with this in mind, got a very nice backdrop here for small stocks. Let's go ahead and take a look at my two favorite small caps right now. They're breaking out. So the first stock we want to look at today is Synchronoss Technologies. That's ticker SNCR, and they're a roughly $193 million cloud services tech company. They help big tech companies and telecoms deliver personal cloud services. They have a white label personal cloud service that they offer for Verizon. They work with AT&T. They work with Amazon. They work a lot of the big companies, kind of offering the services that these guys. Cloud services that Synchronoss specializes in, right? And they just reported earnings last week. Let me pull up my pointer here. Take a look. They beat on sales. They beat on earnings. And the market rewarded the stock with a massive boom. What I really like about the three things I love about Synchronoss right now, you've got here with this post-earnings breakout, you've got a breakout of a retaking of the 200-day moving average. Again, I've showed this pattern here for the last couple of weeks, but you see just the 50-day moving average is moving higher. We're closing in if the action continues stable on a golden cross here, where the 50-day moving average crosses over that 200-day. And this 200-day moving average is so important because it signifies a long-term trend, right? So you're starting to see the 200-day moving average flatten out. You've got the breakout post earnings above that 200-day moving average on the stock. As you can see here, the stock has really traded, basically since March in this $4 to $2 range, and breaking out of that range, you have that's $2 in the $2 range. This breakout here, even though the stock pulled back a little bit yesterday, it's held above that $4 level, and thus far, this $4 level holds, that takes the price target on the stock. You slap that $2 range on top of the $4. That gives you $6 of upside, and that's about 39% from where the stock closed on Tuesday, about $4.31. The second thing, again, it's a momentum tech play. It's a momentum play. You've got the double play action of small caps under momentum moving higher. You've got tech, which has led the market here easily. Even if you take out the COVID crash, it's led the market easily for the last 10 years. You've got a lot of money moving into these stocks, and these smaller stocks like Synchronoss, they're more or less food for big tech. So any one of these small stocks that you invest in here, especially these ones that are good stocks in growth markets, the cloud services market for Synchronoss isn't going anywhere at all. It's only growing, especially as 5G rolls out. This is the kind of company that's going to get snapped out. It could easily get acquired by a company like Verizon, by a company like AT&T, right? Telecoms beefing up their own internal cloud services, or a big tech company that wants to take a company like Synchronoss or other cloud services companies off the market for other competitors, make them exclusive to them. So we're seeing that kind of merger and acquisition activity happening right now. So a lot of good things here for Synchronoss. The last thing I love, having such a massive earnings beating on both the top and the bottom line. You typically see these stocks continue to rise in the roughly 30 to 60 day period after earnings. We call this market phenomenon post earnings announcement drift. And as you're seeing more and more stocks outperforming estimates, this stock like Synchronoss that has massively outperformed expectations, seeing money kind of flow. You can expect to see money flow into this stock over the next couple of months and just ride this rally higher. So it's pulled back a little bit as of yesterday. Small caps in general pulled back a little bit yesterday, but this is a fantastic entry point here around $4. You've got again, you've got the 200-day moving average as support. You've got that $4 resistance, which should become support here, and you've got the 50-day moving average, which has provided support for the stock as it moves higher. So a lot to love here in Synchronoss Technologies right now. Again, that's ticker SNCR. All right, so let's take a look at the second stock on my list. This is Sharpspring. Sharpspring Incorporated. That's ticker SHSP. As you can see here, let's just zoom in here on the last 1 year. Big breakout again. Another performer post earnings. So Sharpspring, I should say, is a roughly $100 million cloud marketing services company. They help small businesses or just internet businesses in general provide digital marketing like email services, SMS, text services. Getting marketing out to subscribers or otherwise customers of these businesses. And what I love about Sharpspring right now, again, just like Synchronoss had a big earnings beat, and on that beat you saw massive action. Yesterday alone, the stock jumped 10%, and in that, let me pull up my pointer again. Yeah, it's post earnings. You see the stock smash above the 200-day moving average, and as you can see here, the 200-day has flattened. In fact, it is basically flat here, which is very positive. That tells you this stock, which was in a longer-term downtrend, the trend is flattened, and the 50-day moving average, which there's the shorter-term moving average, and that measures roughly a quarter's worth of activity here. You see here it's rising. We did have a little bit of a spill in late July, but the stock has recovered in a big way since then, and the 50-day re-established support. And you see here the longer term trend breakout. The stock, put in its 1 year high back here in February, and you see here the stock has tried to get above the 200 and above this, form this kind of downtrend line. But again, you see here just ahead of earnings, it breaks out of the downtrend, and then after earnings, breaks out above its 200-day moving average. And again, like I've said for weeks now, I love this pattern here where you have a flattening 200-day and a rising 50-day. And just taking a look here, the last thing here before I dive into that pattern again is you've got here the $10 level being resistance here, being that level that stock has tried to push out of and failed. You've got two really, you got two good tests here. The last time was back in May. Stock pulled back, didn't make it, but on earnings here, you got a big bump here on mostly above average volume here. But you take a look. So again, just like before, the stock is traded really between 5 and 10. This breakout here, that $10 level post earnings, that's a $5 range. You put that on top of the 10, that gives you about $15, and that's even higher than the high that was put in here, just below $14. But again, like I was saying about this this pattern here, where the 200 days flat, you got a rising 50-day. You've got several layers of support, right? Kind of, think about it as, having wingmen back there, or just entering a position on the stock here around this level here. You've got the 200-day moving average as support. You've got the 50-day moving average as support, and really, if you take, you've got this $10 level. It hasn't been retested yet, but again, you've got two strong levels of support, and then another potential layer here at $10. And as this stock moves higher, there's another cloud services company. And I can't stress this enough, as 5G rolls out, these cloud companies are going to become very, very important. It's still fairly quiet, 5G, but the momentum behind the infrastructure build out, Verizon has spent billions, AT&T has spent billions, T-Mobile, Sprint, they've spent billions building out this network, knowing that this is going to be a massive opportunity for growth. As we can deliver, online internet services will be delivered faster than ever before over on our mobile devices or inside our own homes. It's can't stress how what a big opportunity this is. So these companies, again, you've got a lot of momentum here, and these smaller stocks now have momentum coming out of the recession here. We've got a lot of positive momentum for small caps, for tech, and then these companies specifically that work in the 5G realm. So a lot to love here with these two companies. Again, this is Sharpspring Incorporated, ticker SHSP, and the first company we looked at was Synchronoss Technologies, ticker SNCR. But again, small caps, some of my favorite stocks. I'll be taking a deeper look at small caps here over the next couple of weeks, but again, a lot to love here. If you're looking to go big, think small, especially if you're behind in your retirement, because these stocks can offer explosive growth. Just remember that they're more volatile than your bigger stocks, so you'll want to size your positions appropriately. And you may want to take a closer look at, keep an eye on these stocks as you hold these positions as they move higher. But again, that's basically the small cap stock breakout report right here. And again, thanks so much for watching today's video. And if there's anything particular that you'd like to see moving forward, please leave me a comment here in the box, or shoot me an email. I'll be happy to take a look at that for you. But again, for Rich Retirement TV, I am J-Rod, and I'll see you next week.